that income isn't actually paid to Bruce. Instead, the trust actually lends or pays it to Julia, and Julia is on the top marginal tax rate. And so Section 100A is fundamentally meant to capture situations where the distribution and the tax liability goes to one beneficiary, but the actual benefit of that distribution, the actual cash, goes to someone else. Or the third sort of situation is that the trustee lends those funds to another entity within the group on commercial terms, and then that third entity uses it either for working capital or as part of an investment asset that it owns. So that's the working capital condition. It needs to be used in the business. Yeah, so I guess then the question is, well, this is trying to tease out, well, okay, we can't say there's an agreement with James because it was just a mere expectation. But what if there was an agreement between the trustee and the trust accountant? So the first criteria, if you've got it in front of you, is there needs to be a present entitlement created to income. And when they talk about income, they're talking about income of the trust estate or trust income or distributable income. They're not talking about taxable income. So there needs to be trust law income. So does a capital gain form part of trust law income or not?
What's the answer? Shh, don't say that for any newbies on the line.
Yeah.
Does capital gains included in the trust income?
Yeah.
If newbies want to go, have a go. How do you know?
Yay! Yes, the mantra, read the deed. Let's apply the elements. Well, okay. Was there a beneficiary, non-illegal specific present entitled income? Yes, it definitely was. So that's not contentious here. Was an agreement, arrangement, or understanding? Well, again, we go back to that other example we looked at. Is it just a mere expectation each year? Has there anything been agreed with the kids beforehand? The way I kind of look at our kids, and I've kind of summarized it in this kind of diagram, I think we're kind of in like a risk spectrum of whether 100A applies. So if 100A is made entitled to trust income, then I think if that amount is paid to the child and this child's used for their benefit, there's low or no risk that 100A would apply.